Over the last few years, we have seen a massive shift in consumer behavior. People are becoming far more health conscious, whether it's cutting down on sugar, adding protein to their diets, or trying out supplements and nutraceuticals. The wellness and nutrition space, which was once considered niche, is now becoming mainstream. And interestingly, this is not just an India story. Globally too, consumers are spending more on preventive health, functional foods, and self-care products. Clearly, healthcare is no longer just about hospital and medicines. It's also about what you consume every single day. Now, here is where it gets really interesting. One of India's most respected mutual funds, Parag Parikh flexicap, which is widely known for its value investing approach, has recently added a company from this very sector into its portfolio. A company that has built some of the most trusted wellness brands in India and is now expanding its play into high growth categories and even global markets. I'm talking about Zydus Wellness, that is currently a roughly around 15,000 crore company. Recently, Parag Parikh has purchased 7.27% stake in the company at 1900 per share. Interestingly, Quant Small Cap Fund, that is known for momentum buying, has also increased stake in the company. So in this video, we'll deep dive into Zydus Wellness journey, its brand portfolio, growth prospects, financials, and key risk. Most important, we'll try to understand why Parag Parikh is betting on it. But before that, a disclaimer that this video is only for education purpose. Please do your own research before investing your money. Alright, let's get started. So Zydus Wellness journey started in the 90s. Back then, Cadila Healthcare, which is now known as Zydus Life Sciences, launched a product called Sugar Free. At that time, India wasn't even talking about calories or sugar substitutes. But Zydus saw the trend early. That one bet paid off big time. Today, Sugar Free has a virtual monopoly with over 90% market share. Later in 2009, Cadila decided to separate out its consumer business. That's when Zydus Wellness was born. From day one, company's focus was clear: to build a portfolio around health, nutrition, and personal care. The first few years were carried almost entirely by two brands. First was Sugar Free, that kept riding the wave of rising awareness towards diabetes. Second was Everyuth, that built a niche in skincare with peel-off mask and scrub. If you're a teenager in the 2000s, you'd probably had an Everyuth product lying around at home. But in 2018, Zydus made a bold acquisition. They bought the India consumer business of Heinz for about 4,600 crore. At that time, Zydus Wellness market cap was roughly in the range of 8,000 to 9,000 crore. So the deal size was nearly half of Zydus Wellness' own market cap. Overnight, their portfolio exploded. They got Complan, one of India's most recognized health drink, Glucon-D, the #1 glucose powder brand, Nycil, a summer essential for decades, and Sampriti ghee. That one deal gave Zydus scale and credibility. From being a niche player, suddenly they were competing in the big FMCG league. Now fast forward a bit, Zydus realized that just sitting on legacy brand is not enough. They needed to tap into new age consumption trends. So in 2024, they bought Natural India, the company behind RightBite Max Protein. This was a smart move because health-conscious young consumers are shifting to protein bars, cookies, and on-the-go nutrition. RightBite gave Zydus a foothold in the fast-growing space. And then, recently on 29th August, Zydus announced the acquisition of a UK-based company called Comfort Click for £239 million. That is around 2,800 crore. Comfort Click runs digital-first supplement brands like Weight World and Enemigo. With this, Zydus not only entered the global vitamin and supplement market, but also picked up strong D2C and e-commerce capabilities, and also went global for the first time. In short, Zydus Wellness has been steadily transforming itself from a single product company into a holistic wellness player with a mix of nutrition, skincare, personal care, and now international supplements. Now, such information are very crucial to identify new investment opportunities. Obviously, for a person with a job or business, it becomes really difficult to track the market closely. That's where I try to add value by keeping a close eye on more than 200 companies with their quarter results and share it with my exclusive community via weekly video series. Again, the idea is not to give buy-sell call. The idea is to help identify new trends and opportunities and how to study businesses. I also discuss my own investment strategies. For more details, you can explore my website or check the join button of this YouTube channel. Now, this slide is showing how Zydus Wellness brands are well aligned with global health and wellness trend. First global trend is low sugar, no sugar. Here with brands like Sugar Free and I'm Light, companies catering to rising demand for healthier, low-calorie, sugar substitute and chocolates, cookies. Second trend is high protein, with brands like RiteBite, Complan, Ymax, companies focusing on providing protein solutions across snacks, bars, and meal replacement. Third trend is on-the-go hydration energy, with brands like Glucon-D, Activires, companies focusing on expanding ready-to-drink energy and hydration products for convenience. Fourth trend is functional skincare, with brands like Everyuth, Nycil, companies focusing on products with natural ingredients and functional benefit. Fifth trend is active lifestyle, with brands like Max Protein, Nutrilite, companies focusing on supporting health-conscious consumer with products suited for fitness and daily activity. If you look at company's financials, its revenue in the last 10-11 years have grown from around 400 crore to 2,700 crore. That's a brilliant 20% CAGR growth. However, in the last 5 years, the revenue growth has been on the lower side with just 9% CAGR growth. Then if you look at the margin, it was in the 20s, touched high OPM of 24% in 2018 and then margins slipped to current levels of 14%. As a result, company's net profit growth is on lower side. In fact, in last 3 years, company's profits have remained almost flat. So by looking at the financials, the net profit growth is not very exciting. And that is one key reason why its share price was kind of stagnant in last 5 years. But valuation wise, company PE ratio has fallen significantly and even price to sale has corrected significantly. Now the question is, if company is struggling with earning growth, then why Parag Parikh flexicap fund that is known for its value pick investing has taken bet on the company? Let's discuss it. So first key reason is the weakness in company's margin and net profit growth in last few years is due to cyclical headwinds. They are not structural damages. Actually, FMCG companies have been facing commodity inflation in raw materials like milk powder, sugar, oil, etc. It was the first key reason for fall in margin. Second reason was integration of Heinz business in 2019 added depreciation, amortization and interest burden. And now management has guided that raw material inflation is beginning to show signs of easing. So that should improve the margins from 14% to 17-18% in the next couple of years. Apart from this, I guess the bigger reason could be the shift in consumer behavior. Health and wellness as a category is growing at a fast rate. Low sugar, high protein, functional skincare are mega trends, and Zydus is uniquely positioned at the intersection of healthcare and FMCG, something few Indian companies can claim. Their acquisition of RiteBite is very exciting, where its max protein bars are already number one in the category. It is growing at 25% CAGR rate and management expect the growth momentum to sustain at 25% CAGR in coming years. In fact, in the latest con call, management mentioned that over the next 2 to 3 years, will continue on a structural double-digit growth journey. So from 2% CAGR growth, if they can grow in double-digit, it would be very interesting. On top of this, the latest acquisition of Comfort Click is again very exciting. Comfort Click is a UK-based D2C health and wellness platform with a product portfolio across nutraceutical, personal care and supplements. This slide gives a good idea of Comfort Click portfolio. It includes Weight World that include plant-based supplements, vitamins and minerals, collagen, omegas, probiotics and micronutrients and sport nutrition for adults. Second is Max Medics, a specialty VMS gummy brand which caters to all pediatric nutritional requirement. Third is Enimigo, a natural pet VMS brand that offers a range of pet care products. Please note that Comfort Click has generated revenue of 1600 crore in FY25, which is around 60% of Zydus' own revenue. And in last 5 years, the business has compounded at 57% CAGR rate. With this acquisition, Zydus get immediate access to digital consumer insight, data-driven marketing and e-commerce execution capabilities, something it has historically lacked in. This can help Zydus strengthen its own online distribution in India and abroad. Currently, 97% of their business comes from India, but after the acquisition, 40% is expected to come from outside India. Then another advantage is Zydus' current products are in mid-market price-sensitive categories. Comfort Click's brands are premium priced. This will improve overall margin and position Zydus in a more premium wellness space. Plus, Zydus can cross-leverage its Indian brand like your sugar-free, Complan, Everyuth, Glucon-D, Max Protein into international channels while also bring Comfort Click's brand to India. Okay, so far we have discussed the positive side of the story. Now let us look at the key risk in terms of what can go wrong for the company. So first risk is stagnation in core categories. Zydus' core brands are solid and widely distributed, but they are trapped in low growth or declining categories. For instance, the acquisition of Complan in 2019 was expected to be a huge growth driver. However, it has been under pressure due to rising competition from Nestle, Abbott, HUL and changing consumer preference, where urban parents are shifting towards protein shakes, snack bars and specialized nutrition instead of traditional malt-based healthy food drinks. Then Glucon-D is a market leader in glucose-based energy drink powder. However, this category is highly seasonal, with peak demand during summers. Beyond summer, there is limited consumer relevance, and urban consumers are moving towards energy drink and sport drinks for year-round use. Then Nycil is also a summer-focused brand. Here also, the powder category is on decline as consumers are shifting to lotion, spray, roll-on for skin protection. Everyuth is a well-known brand in scrub peel-off but missing out on fast-grown skincare format. So the growth is modest, but it's not a category leader. Then second risk is integration risk of acquisitions. Zydus Wellness has been quite acquisition heavy in recent years, from Heinz India's portfolio to RiteBite and now Comfort Click in the UK. While acquisitions can accelerate growth, they also bring integration challenges. Comfort Click is 100% digital first D2C brand based in Europe, which is very different from Zydus' strength in offline Indian retail. So integrating tech-driven supply chain, fulfillment models and regulatory compliance across border will require fresh capabilities. Then there can be cultural integration challenge. In India, Zydus sells mass market FMCG brands through international retail and chemist. Comfort Click sells premium supplement online in Western market. Aligning Indian market mindset with European D2C consumer insights could be tricky. Then third risk is competition risk. While the legacy portfolio continue to face stiff competition across category, the new growth drivers like Max Protein are fighting against multiple D2C brands like GoFit, Yoga Bar, Super You, The Whole Truth Food and so on. So it would be important to keep a close eye on competition and watch the growth closely. Then fourth is financial risk. Here please note that the new acquisition of Comfort Click is worth 2,800 crore. Now I'm still trying to understand how company would fund this acquisition because they don't have that much cash. Most probably it would be via debt financing. In that case, it would increase the interest component. Also currently, Zydus Wellness is not paying significant tax due to earlier accumulated losses and depreciation. Before Comfort Click acquisition, management mentioned that for this FY 25-26, there won't be any tax. For next year, there could be some minimum, maybe marginal tax. Maybe you can take it about 8-10%, and going forward in the next year, it will be at a full tax rate which is at 25%. So with Comfort Click acquisition, Zydus top line would expand, but due to potential interest cost and taxes, there would be pressure on EPS growth. Also, please note that currently Zydus has a very low ROE and ROC profile, although the cash conversion is top-notch with CFO to EBITDA of 99%. So to sum it up, Zydus Wellness is at a very interesting crossroad. On one side, its legacy brands like Complan, Glucon-D, Nycil and Everyuth are facing competitive pressure and the growth has kind of slowed down. Margins have also slipped from 20s to the mid-teens, which has kept earning growth muted in recent year. Although now margins are expected to improve. But on the other side, company is steadily reinventing itself. With bets on RiteBite, Max Protein and the recent Comfort Click acquisition, Zydus is aligning itself with fast-growing global megatrends like low sugar, high protein, functional nutrition and digital-first wellness. Management is guiding for margin recovery to 17-18% over the next couple of years. And international business could scale to nearly 40% of revenues post Comfort Click acquisition. Yes, there are risks like integration challenges, rising competition, financial pressure from debt and tax, but that's exactly what makes the story interesting. Well, investors like Parag Parikh flexicap see this as a case of cyclical headwinds, not structural damage, and are betting that Zydus' strong brand equity plus new growth engine will deliver compounding over the long term. As always, whether Zydus turns out to be a classic turnaround play or remains stuck in stagnation will depend upon execution. Thanks for watching this video. If you find it useful, do share it within your circle. I'll see you next video. Till then, take care.